On December 1st, 2001, in Argentina, perfectly normal people woke up and realized their money wasn't exactly their money anymore. The banks didn't collapse overnight. The doors were still there. The screen still worked, but the cash was suddenly rationed. 250 pesos a week. That's it. People stood outside ATMs like it was a hurricane warning. Pots and pans started banging in the streets. And the most terrifying part is this. A lot of those people thought they were the responsible ones because they kept cash. My name is Tom, and I spend way too much time thinking about cash, inflation, interest rate games, and the psychology of why smart people keep making the same money mistake. If you're someone who works hard, saves hard, and still feels like prices are sprinting away from you, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact mechanism that quietly drains your buying power while making banks and brokerages richer, and why the just hold cash and wait strategy is basically volunteering to lose slowly. And to show you the pattern, I'm going to take you back to that Argentina story, because once you see what happened there, you'll finally understand what's happening here in a much cleaner suit with a much nicer marketing brochure. Look, I already know what you're thinking. Tom, come on. The United States isn't Argentina. We have FDIC insurance. We have stable institutions. Holding cash is the safe move. I'm not trying to get fancy. But now you might think, I'm about to tell you to dump every dollar into stocks like a lunatic. No, that's not what this is. This is about something more annoying, more subtle, and honestly, more infuriating. Most people are not holding cash as a smart defensive strategy. They're holding cash as an emotional strategy. They're paying for a feeling. The feeling is, I'm safe. The price is the slow confiscation of their future options. And here's the first punch in the face. Cash is not neutral. Cash is a position. It's a bet. It's a bet that the dollars you hold today will buy roughly the same amount of life later, or at least not meaningfully less. And since 2020, that bet has been getting absolutely smoked. Let's do the boring proof first, because if we don't do the math, you'll assume I'm exaggerating. According to the Consumer Price Index data tracked by the Bureau of Labor Statistics and published through the Street Louis Fed's Fred database, the CPI level was about 259.1 in January of 2020. By September of 2025, it was about 324.3. That's roughly a 25% rise in the general price level over that span. In normal language, something that cost $100 back then costs about $125 now. Now you might be thinking, yeah, Tom, I felt that. Groceries, rent, insurance. Don't remind me. Good. Because that pain you felt has a number attached to it. And once you attach a number, you can stop pretending it's just vibes. Here's what that 25% does to real money. If you had $100,000 in cash sitting around since early 2020 in a checking account, in a safe savings account, under your mattress, whatever the purchasing power of that stack is not $100,000 anymore. It's closer to $80,000 worth of 2020 buying power. And I need you to sit with that. You didn't lose it in a crash. You didn't get an alert. You didn't feel a dramatic moment of panic. It just bled out through the floor like a slow leak. And that's why it's so dangerous psychologically. Humans don't react to slow leaks. We react to explosions. Cash doesn't explode. It decays. This is where it gets really interesting. Most people think the risk is the stock market. They think risk is red candles, headlines, and volatility. But inflation is risk. It's just risk that wears a disguise. And the disguise is normal life. Okay, now let's talk about the second punch in the face. Even when rates are high, most people still earn almost nothing on their cash. You see a headline that says interest rates are up, and you assume your money is finally working for you. But here's what the FDIC's own national rate data shows. The national savings rate around December 2025 is about 0.39%. Not 3.9, 0.39. And in the same month, the yield on a 3-month Treasury security is around 3.64%. So what's happening? We have this weird world where the risk-free rate in the market is roughly 3.64%, but the default savings rate most people actually receive is about 0.39%. That gap is not an accident. That gap is the business model. Let me translate it into a simple example. Imagine you keep $50,000 just in case in a typical bank savings account paying around 0.39%. In 1 year, you earn about $195, not per month, per year, and that's before taxes. Meanwhile, if that same $50,000 earns something like a treasury bill type yield around 3.64%, you're talking roughly $1,820 per year. So the difference, the money you are donating by staying lazy with where your cash sits, is roughly $1,600 per year on just $50,000. Now scale that up. If you keep $100,000 idle the same way, you're donating roughly $3,200 per year relative to what the market is paying on short-term government paper. And this is where people do something hilarious and tragic at the same time. They'll spend 3 weeks negotiating the price of a car down by $1,000. They'll drive across town to save 20 cents per gallon. But they'll leave $100,000 parked in the financial equivalent of a broken vending machine and call it being conservative. Look, I'm slightly frustrated because I know exactly why this happens. It's not because you're dumb. It's because your brain categorizes cash as not an investment. So you don't apply investment logic. You apply comfort logic. And comfort logic is expensive. Now you might be thinking, okay, Tom, so I'll just move it to a high yield savings account. Better, but still not the full story. Because the real enemy is not just low interest. The real enemy is the combination of 3 forces. 1, inflation pulling your buying power down. 2, taxes taking a bite out of whatever interest you do earn. 3, opportunity costs, the stuff you could have owned while you waited. Let's break that down in a way that actually matters to your life. Say inflation is running around 3%. That's been in the neighborhood of where the CPI 12-month numbers have been in recent official releases, like the September 2025 CPI report showing 3.0% over the prior 12 months. And economists were expecting a little uptick into the low 3s for the delayed November reading. If your cash earns 0.39% and inflation is around 3%, your real return is deeply negative. It's not negative by a tiny amount. It's negative by something like 2.5 percentage points. So you're losing purchasing power even before taxes. Then taxes show up and kick you again. If your interest is taxable and you're in, say, a combined marginal bracket where your interest gets shaved, your after-tax interest might be even less than that tiny number. So your real return is worse. So cash, for most people, is not safe. It's an asset that reliably loses buying power over time. Now here's the part nobody wants to hear. That might still be fine for a small bucket of money, because you do need liquidity. You do need an emergency buffer. You do need money that can be moved fast. But most people don't have an emergency fund. They have an anxiety fund, and those are not the same thing. An emergency fund is sized to a realistic set of emergencies: job loss, car repair, medical deductible, a roof leak, a sudden travel expense. An anxiety fund is just as much as possible because the presence of cash is being used as emotional armor. But emotional armor has a monthly fee, and that fee is paid in lost future freedom. Now you're asking yourself, so what's the right amount of cash? Good question. And here's my answer, and it's gonna annoy both extremes. The correct amount of cash is the amount that reduces the probability of you doing something stupid, not the amount that makes you feel invincible. Cash has a job. Its job is not to make you rich. Its job is to keep you from becoming poor due to timing problems. A timing problem is you need money at the exact same time your other assets are down. So cash is insurance. And like any insurance, overbuying it is a waste. Underbuying it is dangerous. But buying infinite insurance is just fear dressed up as prudence. Okay, Now let's get into the psychological trap that makes cash so seductive, especially for ambitious men. You like control. You like optionality. You like the idea that if something goes wrong, you can move fast. Cash feels like a loaded magazine. You feel prepared, and that's why cash is emotionally addictive. It gives you the illusion of control over an uncontrollable world. But here's the dirty secret. Most people do not deploy cash when opportunities show up. They freeze, they hesitate, they overthink, they wait for confirmation. And by the time their nervous system calms down, the opportunity is gone. This is why dry powder is one of the most expensive phrases in personal finance. Because the people who talk about dry powder the most are rarely the people who actually shoot. They just like the feeling of holding it. And we have real-world evidence that behavior ruins returns. Dalbar's investor behavior research, for example, repeatedly shows a gap between what the market returns and what the average investor actually earns, because people buy and sell at emotionally bad times. In the 2024 data discussed publicly, the average equity investor lagged the S&P 500 by several percentage points, not because they picked the wrong stocks, because they picked the wrong moments. Now you might think, fine, Tom, but I'm different. I'm disciplined, I'll wait patiently, then I'll buy when it crashes. Okay? Let's test that belief. When markets crash, you don't get a polite email that says, "Hello, sir. This is your once-in-a-decade buying opportunity." What you get is chaos. You get layoffs. You get fear. You get headlines about contagion and recession and banks and war and whatever the story is that week. And in that environment, buying doesn't feel like a smart move. Buying feels like jumping into traffic. This is why the best market days tend to cluster near the worst market days. Volatility is where the rebounds happen. And if you step out to wait, you often miss the snapback. Even big institutions publish the warning. Trying to time the market can mean missing a handful of crucial days that do a massive percentage of the compounding. So the cash strategy is often based on a fantasy version of yourself, a calm, rational, machine-like you who doesn't exist when the world is on fire. Now we can finally talk about the real point of this video. When people say it's the worst time ever to hold cash, they usually mean inflation is high, so cash loses value. That's true, but it's not the most important part. The most important part is this. It is the most profitable time ever for financial institutions for you to hold cash the dumb way, because the spread between what your cash earns and what it could earn is basically free money to someone else. And that someone else is not a cartoon villain twirling a mustache. It's a system of incentives. It's banks using deposits as cheap funding. It's brokerages sweeping your idle cash into programs that pay you less than market rates. It's the entire industry quietly monetizing your inertia. This is where it gets really interesting, because once you see how it works, you can't unsee it. Let's talk about brokerage cash for a second, because people are finally waking up to this. In many brokerage accounts, uninvested cash doesn't just sit there as neutral. It gets swept into a cash program, sometimes into an affiliated bank deposit, sometimes into a money market fund, and the rate you receive can vary massively. The SEC's own investor bulletin warns that bank sweep programs often pay less interest than money market sweep programs, and that terms can vary significantly. And you know why this matters? Because cash drag is silent. You can be a smart investor picking decent index funds and still get crushed because you always carry too much idle cash, earning basically nothing. And there is evidence this is not small money. One example that shows the scale, Charles Schwab has reported client transactional sweep cash balances in the hundreds of billions of dollars. And those balances matter because net interest revenue is a major revenue source for brokerage-linked banking models. In their reported disclosures, you can literally see sweep cash discussed as a balance sheet advantage. Again, this is not evil, it's business. But if you don't understand the business, you become the product. Okay, now I promised you we'd go back to Argentina, and it's time. Because that story is the extreme version of the exact same pattern. Cash is political, cash is controlled, and cash gets rationed or devalued when the system needs it. Let me set the scene. Late 2001, Argentina had been locked into a currency peg where 1 peso was legally treated like $1. On paper, it was stability. In real life, it was a pressure cooker. People started to fear devaluation, so they tried to pull money out. Not because they were reckless, because they were paying attention. Banks started bleeding deposits. And then the government made a decision that felt temporary and technical, but had life-changing consequences. They restricted withdrawals. The famous number that got burned into people's brains was 250 pesos per week. You could still swipe your card. You could still do electronic transfers, but physical cash was capped. And here's the psychological brutality of it. When you tell a population your money is safe, but you can only touch a little bit, you're not calming people down. You're telling them they were right to panic. According to crisis accounts and policy summaries referenced by institutions like the IMF, the controls included that weekly limit, roughly equivalent to $250 at the time. Now, rising action. How does the mechanism actually destroy people? Step 1. Withdrawals get limited. People can't access their funds freely. Step 2. Confidence collapses anyway because restrictions are basically an admission that the system is fragile. Step 3. The currency peg breaks and the peso devalues hard. Step 4. Deposits and debts get forcibly converted and the real value of savings gets shredded. That's the mechanical sequence. But here's the human sequence. People who had spent years doing the responsible thing, saving cash, holding deposits, not gambling, suddenly realized they had been playing a game where the rules can change when the system is stressed. The crisis point is the moment you understand you don't have a savings account. You have a claim on a system, and the system has priorities. Now, I'm not here to pretend the United States is about to do a Corralito. That's not the point. The point is, cash is not a magical substance. It is a contract. Your dollars are only as free as the rules of the system at that time. And even in stable countries, one of the most reliable tools governments and central banks use during long periods of stress is something much quieter than a cash withdrawal cap. It's called inflation. And inflation is functionally a haircut on cash. It's a way to reduce the real value of liabilities while making people feel like nothing dramatic happened. So what does this have to do with you holding cash right now? Everything. Because the modern version of the same pattern is not, we cap you at 250 pesos. The modern version is, we let your cash sit earning a tiny rate while prices rise and the difference gets absorbed by the system. You don't riot. You just slowly give up things. Fewer restaurant meals, a cheaper vacation. You delay replacing the car. You decide not to upgrade your living situation. And you tell yourself you're being responsible. Now, you might think, okay, Tom, but stocks are risky and valuations are high, and I don't want to buy at the top. Fair. So let's be adults and separate two different decisions. Decision 1, how much liquidity you truly need. Decision 2, what you do with the rest. Because the biggest mistake is treating all cash like emergency cash. Emergency cash has rules. It needs to be liquid and stable. But waiting cash is different. That's the pile you're holding because you think a better deal is coming. And here's the uncomfortable truth. Waiting cash is a market timing strategy. You are timing. Even if you tell yourself you're not timing, you are timing. You're saying, I choose to hold purchasing power today because I believe future prices of assets will be lower and I will have the courage and precision to buy then. That's a very specific claim, and most people are not honest about the burden of that claim. So let's do the everyday analogy because it'll make this click. Imagine you go to your favorite grocery store and they offer you a stability card. You can prepay $1,000 today and they'll hold it on your account. Feel safe, right? Your money's right there. For the first month, nothing changes. You feel smart, but then the prices in the store rise, 3%, then 3% again. Then suddenly you look up and it's been a few years and prices are up around 25%. Now, your $1,000 doesn't buy $1,000 worth of groceries anymore. It buys about $800 worth of the old groceries. But here's the trick. The store keeps showing the same number on the screen, $1,000. So your brain relaxes and you don't feel robbed until you go to check out. That's cash. Cash is the stability card where the number stays the same while the contents of what it can buy shrink. And if the grocery store also says, don't worry, we'll pay you a little thank you, but the thank you is like $4 a year, you're not being compensated. You're being pacified. Now connect that to your bank. If your bank pays you around 0.39% while prices rise around 3%, the bank is basically that store. They're not stealing in a dramatic way. They're just letting you quietly lose. Okay, now we can do the antagonist reveal because the pattern has a beneficiary. Who benefits when you hold cash the lazy way? First, banks. Deposits are funding. If they can pay you near zero and lend or invest at higher rates, the spread is profit. Second, brokerages and wealth platforms. Uninvested cash can be swept into programs that generate net interest revenue. If you're defaulted into a low yield sweep and you don't change it, your inertia becomes revenue. Third, governments indirectly because inflation reduces the real burden of debt and acts like a stealth tax on holders of cash and fixed claims. And the motive is simple. Cash is the cheapest source of funding, and most people don't shop it. You shop for a mortgage rate because it's painful. You don't shop for a cash rate because it's boring. That boredom is worth billions. Now, how do they hide it? 3 tactics, and once you see them, you'll notice them everywhere. Tactic 1, they frame cash as not an investment, so you don't compare it to market yields. You compare it to zero. And if you compare it to zero, anything looks fine. Tactic 2, they talk in nominal terms, not real terms. They'll tell you your balance is stable. They won't show you what it buys. Tactic 3, they rely on defaults. Default sweep options, default savings accounts, default checking behavior. If you never touch the settings, you accept the worst deal. And the emotional reframe you need is this. You are not being conservative by holding too much cash in the wrong place. You are being harvested. I know that sounds dramatic, but I mean it mechanically, not emotionally. Your inaction is converted into someone else's margin. Now you might be thinking, so what do I do today, like literally today, to stop being the victim here? Good. Here's the immediate move, and it's specific. Today, you're gonna run a 2-minute audit called the cash reality check. Step 1, open every place you keep cash. Checking, savings, brokerage cash, money market, even that random old account you forgot. Write down the total. Step 2, next to each account, write the interest rate it is actually paying you. Not what the ad said, the actual number. If you don't know where to find it, that's already the point. Step 3, compare that number to a clean benchmark, the yield on very short-term treasuries. Even a 3-month treasury yield gives you a real-time reference for what cash-like can earn in the market. Around mid-December 2025, that number has been in the mid 3% range. Step 4, calculate your spread. If you're earning 0.39% and the benchmark is around 3.64%, your spread is roughly 3.25 percentage points. Now multiply that spread by your cash pile. If you have $100,000 and your spread is about 3.25%, you are donating around $3,250 per year. And that's before considering inflation. That number should make you angry in a productive way because now you have clarity. Now, action based on what you find. If this cash is true emergency money, you still optimize it. Emergency money does not mean accept zero. It means liquid and stable. So you move it to a vehicle that is liquid and pays a competitive rate relative to short-term yields. A treasury-only money market fund, or directly laddered treasury bills depending on your operational comfort. The details depend on your setup, but the principle is the same. Stop accepting the default rate. If this cash is waiting cash, you need to give it a job. And the job is not sit and hope. The job is execute a rules-based plan. Here's a rule I want you to consider, because it kills the emotional decision-making. Pick a target idle cash ceiling in your brokerage and bank accounts that you will not exceed without a written reason. For example, 2 months of expenses in true cash equivalents, plus any known near-term purchases, plus a small buffer. Everything above that gets deployed automatically on a schedule. Not when you feel brave, on a schedule, because bravery is not a strategy. Automation is a strategy. Now, if you're using a brokerage, you also do one more specific thing today. You check what your sweep program is. If you don't know what that means, it means you're exactly the person who needs to check. So you look at your sweep, you look at the rate, and you change it if it's trash. That one change, for some people, is worth hundreds or thousands per year, with basically no additional complexity. And now the final psychological point. Because if you don't fix this part, you'll slide back into the same pattern. Cash feels like safety, but too much cash is just delayed pain. It's you choosing slow loss over visible risk. It's you choosing comfort today over options tomorrow. And the reason I'm so intense about this is because the men watching this video are usually not broke because they're lazy. They're broke because they're cautious in the wrong place. They're cautious about investing. They're cautious about deploying. They're cautious about volatility, but they're not cautious about the invisible certainty of cash decay. So here's the proof boiled down. Prices have risen roughly around a quarter since early 2020, which means idle cash lost a chunk of real buying power. The average savings rate most people actually receive is still tiny, around 0.39%, meaning the default cash experience is basically a guaranteed negative real return when inflation is around 3%. Meanwhile, short-term government yields have been multiple percentage points higher, meaning a lot of the pain is not the economy, it's your financial plumbing. So no, you're not being smart by holding cash. You're being smart by holding the right amount of cash in the right place for the right job. Everything else is just donating to the spread. And if you remember nothing else, remember this. Cash is not a moral virtue. Cash is a tool. Use it like a tool, not like a teddy bear. Because the world does not reward people who feel safe. It rewards people who are positioned correctly, while everyone else is paying for comfort.